Unpack those movements now with Phaswane Mphahlele, Portfolio Manager at Makwe Fund Managers. Phaswane, thank you so much for joining us this evening. How did the market perform today?
Good afternoon, Melissa, and to your viewers. Melissa, when we look at the South African market or the world markets, they are moving in the opposite direction from the bond to the stock market. And this stems from seeing yesterday where we saw the NASDAQ closing in the bear market, triggered by disappointing earnings from big corporates. And the current sentiment had further pressure coming by the fact that sentiment remains among investors that higher interest rates will remain for longer. And as central banks are trying to stem inflation they had created. And that we can see this through the bond yields, which had multi-year highs, and they are consistent with the lack of demand we are seeing right now. Now, having seen today's even big news coming up from data, they didn't help sentiment much. We saw the GDP from the US up 4.9%, and that was a bullish print with the consumer spending, increase in exports, and they helping that number there. And adding on to the bullish, the dovish ECB comments coming out and pausing of interest rates as they take a wait-and-see approach as they view price pressures easing and recession risks. This has just benefited a safety haven type of trade today, as we saw the data get a bit and the rest of the market having to bleed a bit of bleeding there. Yeah, took a bit of bleeding.
Phaswane, if we zoom into the Brent crude price, it's falling. It was at $87, now at about $88. Could we expect some good news in regard to the fuel price announcement next week?
Well, considering that the Brent prices have come down to around about 7% since the breakout of the Middle East conflict, this was to levels, as you mentioned, around 88 at the back of the diplomatic chats and the macroeconomic conditions curbing the big importers not to demand more. And when we add a spin of the rand having to done some bit of improvement, we see there's that we tilt towards a cut in the fuel prices coming into the next month. But it's also very important to then for also caution our drivers here back home that do not use if it happens that we do get a cut, don't use all those funds, because there's still a lot of such uncertainty in the market, still present in the market, and as because the price range of the Brent oil price remains in a bullish setup, and therefore we could see a reversal, and therefore it's better we wait and see. Don't spend all that money.
Let's go now to some company news and to some results. Clicks showed a resilient performance in their annual results that they announced today. What can you tell us about that?
Yeah, Clicks. So despite the challenging macroeconomic environment from high interest rates and inflation, the business model for Clicks continues to prove that it's defensive and helps bring returns for the business to organically grow the number of stores. They're celebrating the 850th store, 700th pharmacy store, and all these stores working together are helping grow their profits. When we look at the adjusted headline earnings per share, it's about 11.5%. And as the revenue has grown because of the group sales up by 8%, thanks to the retail sales growing, and this is all thanks to the network that is so close proximity to half of the South African nation. This has helped the business. Notably, what I'm sure the guys are smiling about is also their margins that are growing higher positively, and thanks to the high-end products getting demand and the beauty products increasing in demand. But overall, solid performance from the guys, improving their cash flows, and more importantly, they're using it to allocate some of it to the capex to improve their networking chain that continues to be resilient and bring more cash flow for them and improve their technology. Further on, as shareholders, we are also pleased because we got also a piece of the cake there. We got some form of dividends and cashbacks, and overall we're happy, and it's reflected in the stock price up by 6%.
Now, Balfour Properties also released some results today saying that interest rates has affected consumer demand and also the home loan affordability for some consumers. And this has definitely affected their sales.
Yeah. The property guys, it's basically they're facing a downturn in the cycle. This is not that time. They had a tough operating environment. We just saw their profits was just up 3%. The revenue took a big knock, at 25%, and it's just reflective of how the housing market is tough. When interest rates and inflation are very high, they negatively impact their clients in terms of their property investing and the affordability part you were talking about there. And this is because the standard of living has come down, so it's not very easy to access this. And this has resulted in them seeing a loss in recognizing revenue on the number of apartments, down by 39%, which worried the market a bit there, but still understandable. But what's good to see is that the guys stood up and became more efficient within their period, where they started to become they focused on being efficient in terms of making some price adjustments, cost controls, and also they're redesigning some of their projects to be more efficient, and they yielded a jump in their profit margins. They're up 33%, and overall their annuity business continues to do well for them. It's almost doubled there, thanks to the demand for their fiber networks or their support service in their estates. But generally, despite this disappointing performance, they were smart enough to also use their dividends to pay up some of their debt, which was I'm happy with what they're doing at the moment to handle everything.
And then lastly, Phaswane, the mining and materials company AfriMat also announced their interim results. What is it saying about that sector?
Well, that sector is going through ropes, as we've seen the mining sector, and as a whole, is seen a decline in prices. But just to zoom in, and these guys, their results, despite the mining sector not having done so well, their results was not disappointing because of the fact that they were able to diversify their revenue streams, especially in that commodity side, where they help offset their local challenges from energy supply and the weak economic growth, economic climate. They managed to balance this very well, to see their revenue pop up by 8.8 billion. Even although the headline earnings per share was just up by 4%, they continue to pay dividends despite these tough times. And this is all thanks to that operational management, well executing on their tasks and making sure that the bulk commodities, especially when you consider iron ore, are well diversified. When the international sales are not doing well, the local sales are improving and they're benefiting on that hard-earned currency. And when we look at the construction side, they still continue to see some demand in terms of the road and infrastructure assets. Are managing it very well, but they couldn't do so well when coming from the industrial front, where because they have a diversified business, the load shedding did a knock on them there, as a lot of their clients actually have to saw a decline in their volumes they had to do in their ordering. But overall, considering where the industry in the mining industry is running through, the guys are managing it quite well there as they continue to pay their dividends.
Thank you so much for your time and your insights. That was Phaswane Mphahlele, Portfolio Manager at Makwe Fund Managers. That's all.